and that will be mailed to all the delegates who are enrolled for this class. The next question it puts us to is on the redevelopment agreement for a tenanted premises. Mr. Lucky, who is holding a tenancy right for a shop premises, and during the redevelopment, he is getting another shop premises with an extended area of 2,000 square feet, which will be on the ownership basis. The stamp duty value of that shop premises which is getting is of 6 crore rupees. What will be the implication of this above transactions for the purpose of capital gain? Now, he has been advised by a chartered accountant who says that he was already in the possession of a shop premises. He is getting nothing but improved title of the property, and accordingly only the difference of the value of the ownership property and the tenanted property can be taxed in his hands. Whether the view given by the chartered accountant is tenable in the law.
I would believe it is not correct. It's a case of exchange of tenancy against ownership of a shop. If he was given a same or a similar shop on a tenancy basis, because tenancy has no cost of acquisition, it has no market value, both exchange would not have resulted in being X line. But here he is made owner of a particular office, which has up the same value limit to 6 crore. So he has got rupees 6 crore. To my mind, the 6 crore minus 0, because cost of acquisition of tenancy entity was 0. On that amount, he will be required to pay long-term capital gain tax. If he does not, probably he may incur obligation to pay full tax as income under section 56(2)(7). Because there is he has received an office without adequate consideration. If he says giving up of tenancy was adequate consideration, it's a capital gain. He can't escape both ways. So I would take up to be liable to pay tax. There are some orders of the tribunal dealing with the case of a flat against a flat. Owner of a flat getting a new flat. There the view is that there is no tax liability. But here it's not a case of a flat against a flat. Here it's a case of the tenancy versus ownership. That is the distinction.
We have a number of decisions of the Supreme Court as well as High Court wherein the view taken is that on retirement of partner, if the retiring partner.
The short question is there is a Bombay Tribunal order because of Sudhakar Shetty 130 IT 197, which has taken a view that if a partner receives the money on his retirement, the amount will be taxable. To my mind, that order is wrong, and it is contrary to various judgments, including judgments of Bombay High Court. The lead judgment of Bombay High Court in this issue is in the case of Prashant Joshi, 324 ITR 154. Recently followed in the case of Riyaz Sheikh, 41 EC 455. I am not going into greater other judgments. I am pointing out the tribunal order has not taken into consideration the judgments of the High Court. They were cited. My understanding is that MA was filed in relation to this order. MA was rejected. I will not know thereafter what has happened at the High Court. But recently, Bombay High Court has again reiterated the view following Supreme Court judgment in the case of Mohanlal Pavabe. I would take a view that Shetty is completely wrong and SSC is not liable to pay tax.
There's one short. First issue also that T.K. Patel 115 ITR is overruled by the Supreme Court in 236 ITR, but it says it is partly overruled. Question for your consideration is whether it is vis-a-vis assessed profit and the return by income, or vis-a-vis the proposition that on retirement there is no transfer.
In relation to that there was a transfer, that part of the judgment was approved. But there is no consideration that part will stand reversed. See, 115 ITR is reversed in 236 ITR.
Yes.
Look at Supreme Court judgment in the case of Lingabala Rajkumar 247 ITR 801. Where also the Supreme Court has taken a view in favor of SSC. Mohanlal Pavabe 165 ITR 166 Supreme Court is in favor of SSC. In fact, you will get all these judgments recently in the case of Karnataka Foodage, Dynamic Enterprise, I can quote 359 ITR 83 Karnataka Foodage, Andhra Pradesh. But as I said, I don't want to go into all because it's going
model of builder introduces land, which is otherwise is stock in trade and introduces it into a partnership form. AO invokes section 45(3), applying very special branch DLF Universal Limited, whether the action of AO is correct.
The tribunal order was in a very peculiar facts. I take 2 minutes to get into the facts. An SSC builder and its 4 subsidiaries formed a partnership. SSC had a piece of land which was held by the stock in trade at the cost of 4.40 crore. It introduced an asset in the books of the firm at 11 crore, got a credit of 11.5 crore. In its books of account, it credited to 7 crore to the profit and loss account and claimed there is no tax liability. Why? Because when I introduce the stock in trade to my partnership firm where I am a partner, there is no transfer. The provision of section 45(2) deals with the situation which is in case of a capital asset. This is the stock in trade. Matter was carried to tribunal. There was a difference of opinion. Whether the larger bench, 2 members took the view against the SSC, 1 member took the view in favor of SSC. The only problem of the division bench which has taken a view against the SSC is this. They say the asset was stock in trade in the hand of the SSC till it was introduced. It continued to be stock in trade in the firm after it is introduced. But a moment before it was introduced, it became a capital asset. So when it was introduced, it was capital asset and there was section 45 in applied. Now by which process of law, an asset which is stock in trade for all past period and it continues to be stock in trade even thereafter, when I am putting it from here to here, it becomes capital asset. Though in its journey from this point to this point, it is capital asset, stock in trade, and from here to there it is stock in trade. At that point, it becomes a capital asset. Very peculiar order. They say the transaction is not genuine. If they would have put it, it is not genuine, it's a different matter. They say it has become for that small period a capital asset. I would say it is not a correct statement. We have a decision of Supreme Court, Kikabe Premchand, and in construction, both taking the view that stock in trade evaluation would not result in any tax liability. At this stage, I will stop. Then we'll see.
We do have some time, I think, up to half an hour we can go. For next question is on section 54 EC, which provides that investments in bonds on sale of the assets is to be made within 6 months from the date of transfer. We have certain decisions which says that even instead, if the consideration is received later, the date of 6 months period will start from the receipt of the date of consideration. To what extent, sir, whether the date of transfer is to be considered strictly or the date of consideration?
I could come across one order of Calcutta Tribunal, Chanchal Kumar Sarkar, 50 SOT 289, which has taken this view. And for the purpose of taking this view, it is referred to one Andhra Pradesh and 2 Allahabad High Court appellate. These judgments of the High Court deal with the situation whereby the SSC received the money on acquisition of land in bits and pieces, originally from the land acquisition officer, then from the district court, then from the High Court, then from the Supreme Court. So when you receive consideration in bits and pieces, this principle might apply. That principle is wrongly applied by the tribunal in favor of SSC. And at the relevant point of time, we did not notice that there was already a special bench order of the tribunal in the case of Jyotindra Shogun, 87-19-312 against the SSC. Ahmedabad bench against the SSC. And now, recently, Gujarat High Court has again held that 6 months would begin to run from the date on which the sale takes place, not the day on which you receive consideration. Therefore, I do not believe that it would be correct. Only one small side issue here. When I say 6 months, what 6 months? Today, let us say we are on 20th of February. 6 months would they be over on 19th or 20th of August? Or 6 months would be from the end of the month of February? Now, I thought that 6 months would be from the end of the current, from the day, natural day to day basis. However, we have a tribunal order of Alka Bedi Patel, 148 ITD 31 Station Bench, Ahmedabad, which has taken a view 6 months would be 6 months from the end of the month. So in a given case, 6 months can be extended to almost 7 months. But beyond that, I don't think you are right to take the
This question is on the convertibility of the preference shares into the equity shares without any payment of additional amount. Whether this will be treated as an exchange and the same is liable to income tax.
This again appear to be very simple problem, but then on greater analysis, it appears to be a very tricky issue. Question is whether it is an exchange or not. Now, I have got three direct judgments taking them, it's an exchange. One of Bombay High Court, 234 ITR 787, another of Delhi High Court, 255 ITR 300, and third of Andhra Pradesh High Court, 102 ITR 258. But why is there a problem? Problem is this. Under section 54(5)(2)(e), cost of acquisition of my second asset is frozen as the cost of the first asset. Let's take a simple example that will be clear. My cost of, let's say, equity share was rupees 100. Let's say preference share was 100. I acquired 5 years back. Today, against the 100 rupee worth preference share, I am getting equity share worth rupees 500. In order to explain the problem, let me go a step further. 3 months down the road, I sell away the equity shares for rupees 550. Question number 1. Whether there is an exchange today, because if there is an exchange today, I will have to pay tax on capital gain. These judgments take away with an exchange. Okay, if there is an exchange, how do I find out the capital gain tax liability? Capital gain tax liability will be found out on the basis of market value of the share received by me in the 500 less the cost of buying the shares in the 100. So I pay tax for 400. I have no problem. Now when I sell this equity share 3 months down the road is 550, ordinarily I should be told that you are sold for 550, your cost is 500, therefore you are required to pay tax on 50. 52E says by a fiction that cost of my equity share is what was cost of my preference share. Which means that I sell equity share for 550. Do I get only rupees 100 or do I get 500? I already paid tax on within the or even with 100 to 500. The third judgment to which I made a reference says that you will get it on 500. But it did not notice 55(2)(e), which is on the statute book right from 1964, which is 1978. The problem is further compounded because whether the second set of transactions will be long term or short term, it will be a short term because I acquired the shares today and I am selling in 3 months. So this issue is, to my mind, not resolved. The only logical way we can look at the matter is by virtue of 55(2)(e), I ought not to be called upon to pay tax today. So though it's an exchange, the tax liability gets postponed to a future date. An issue which is neither argued anywhere, nor the 3 judgments to which I will take a reference deal with the issue. Otherwise today there is an anomaly which is accessible to suffer.
But conversion from preference to equity will always result into capital.
If they say either way, equity to preference to equity is an exchange.
But convertible debenture to equity is not.
No, there is not a share.
No, convertible debenture to equity shares is exempt transfer. Under 47 is exempt.
That's exempt.
Yeah, that's why it is
55 is not exempt. See, there are two. One is whether a transaction is exempt, and if not, what is the mode of finding out tax liability? I find no exemption in the matter of conversion of equity to preference and license. And all these judgments say they are not exempt.
Yeah.
So if they are not exempt, you have to find out tax liability. It is here that I have a problem.
So Mr. Palchiwala in his book has about this Andhra Pradesh High Court, he has said that this Andhra Pradesh High Court is wrong. He has referred some judgment of Goyal, but that is not reported. Some date is given in the 8th edition of the Palchiwala's book. So that is, from that angle also your view is supported.
Thank you.
Okay. Now, question number 21.
There's a company which just returned income 50,000 and book profit is 3 lakh rupees. During the course of the assessment, there is an addition which is happening of 5 lakh rupees and therefore the figures of tax are given. Question which is very short is this that in such a scenario, what will be the penalty which will be this 1,20,000 company 165 with 45 or will it be 1,50,000 which is 30% of 5 lakh rupees which is the addition.
Now has taken a to tax ought to be equated to be tax which is payable post assessment minus tax which SSC had agreed to by taken out in the first part. If that is the correct view, then the penalty would be only just 1,20,000 and not 1,50,000. Now is followed by Allahabad and Gujarat also. So in my view, it is possible for SSC to argue that it's only 120 that penalty is required to be used.
Now, the question number 22, we need to divide into part A and part B. The part A is on the penalty provision under section 221(1), which deals with the asset tax has been paid, but the return of income has been filed late. It is for the assessment year 12-13, self-assessment tax liability which came to rupees 10 lakhs. However, due to some difficulties, he could not file his return of income by making the payment of rupees 10 lakhs. So he made the payment of rupees 10,000 and showed the balance amount. I understand that now if we make this payment without as shown in if we upload the return showing it as payable, either the return of income will be treated as 139.5 the defective return. He could rectify thereafter. Going ahead, subsequently he revised his return of income as per which the liability came to rupees 10 lakhs, 10.5 lakh. By filing revised return, he makes the payment of the entire tax liability along with the appropriate interest which was required to be calculated. Now, whether in this situation penalty will still be leviable under section 221(1), first A, prior to filing of revised return and making tax payment, and second, subsequent to payment of tax and filing of his revised return.
Section 221 is penalty in case an SS is not default. Section 140 capital A obliges every SSC who is filing return of income to pay the self-assessment tax. Subsection 3 says if he has not paid the tax, he is assessing default. Which would mean that when he filed his first return, he ought to pay tax of rupees 10 lakh. He did not pay, he was an assessing default. If assessing officer chooses, he will take action under section 221. He can take action under 221 so long as the amount remains outstanding with only one cap that the total amount of penalty will not exceed the total amount of tax payable. Therefore, it is not as if SSC, once he voluntarily chooses to pay off the money, the obligation to pay penalty may not arise at all. However, Bombay Court has taken two judgments that 221 is governed by the principle of reasonable cause. So if it is found necessary a reasonable cause in not paying the amount of self-assessment tax, there will be no legal penalty. Subject to that, the SSC will be exposed to a possible penalty proceeding under 221.
The part B is on 271(1)(c), wherein in case if the disclosure under survey proceedings is made to buy peace and to avoid litigation, whether that disclosure would amount to penalty provision under section 271(c), that is after considering the Supreme Court decision of Bank Data Private Limited, earlier decision whether that stands over the rule of Sri Shanti.
It is one interesting issue, therefore, let me spend 2-3 minutes on this. In order to appreciate MAK data is like a thermometer. Once the thermometer has been given, the income tax department got a mantra, every SSC is supposed to be penalized. This is now MAK data is another toy that they have got which they are playing in every case. When MAK data data lays down as an absolute proposition. Let's look at the facts. I know we are running out of time, but then let me say 4-5 minutes. Yes. On 16th December 2003, a survey takes place at the premises of the system level of the SSC, where it is found that a lot of bogus share application monies have gone with the SSC company. Bank statements, application forms, transfer forms, blank transfer form, everything is found. SSC filed return of income on 27th December 2004, a year thereafter, does not disclose any undisclosed income. 2 years thereafter, on 26th October 2006, AO issues notice to the SSC, calling upon SSC to explain the share capital. 22nd November 2006, SSC comes forward and says, and I am quoting from the actual words used by the SSC, voluntary disclosure without admitting any concealment whatsoever and subject to non-initiation of penalty proceedings or prosecution. So he accepts it. Additions are made. AO levies penalty, CI table confirms it. Tribunal reverses it. Matter is carried to High Court. High Court reverses tribunal. He levies penalty. Matter is carried to Supreme Court. Supreme Court dismisses the High Court. But what is the principle laid down by the Supreme Court? Supreme Court does not say that in every case there is a surrender penalty has to be used. What Supreme Court says is, one, there is nothing like quote unquote voluntary disclosure, buy peace, avoid litigation, or amicable settlement, the phrases which are used by the SSC to explain the conduct. In the present case, the SSC was aware a year before it filed return of income that department has adequate evidence to show that cash credit is not genuine. And yet SSC does not file return of income declaring this. Till the inquiry starts, SSC does not come forward to accept it. And a year thereafter, when the SSC is caught with no answer, he gives this answer by saying, to buy these are accepted. In such a situation, this surrender is not voluntary. If this is not a voluntary surrender, then the tax must be levied. Shadilal Shukar 168 ITR 705 is not held to be a wrong judgment. But what it says is, if after being aware of your concealment, you still continue to persist with the wrong filing of return of income, you should be penalized. The earlier judgment of Supreme Court in the case of Reliance, 322 ITR 158, in no way gets watered down by this. What does Reliance say? If an SSC makes a bona fide claim, which we ultimately found to be untenable in law, I claim an expenditure which is found to be untenable. I claim a receipt as a capital receipt which will turn out to be untenable. Even then there is no penalty because there is no concealment of income or furnishing of inadequate particulars of income. So the Supreme Court in American data undoubtedly takes a view against the SSC, but it is on peculiar facts. It is not giving a license to the revenue to say additions, penalty, American data. This is not on the basis of additions made on disputed issues that the penalty is levied. This is addition on the suppressed income that SSC later on came forward and declared. So it's only in those cases American data will be hurt you. The only other issue which Supreme Court has made in this judgment, which is little difficult to accept, is Supreme Court says there is no specific mode of recording satisfaction, and therefore even if there is not recorded satisfaction, it is good enough. Now obviously the law is slightly amended, but this is one aspect which requires to be taken into consideration. To put it very, to conclude, MA data will have to be analyzed on facts of that case, and unless it is found that the color of that case matches with the color of your case, I don't believe we are able to do it.
Another burning issue about the bogus purchases. issues on that, wherein the SSC had made purchase of steel during this course of this regular business by account paying checks. The steel is used in manufacturing activity of the SSC, and that we understand that therefore there is no direct correlation of the product purchased and sold. The entries are, however, of the stock are made in the stock inward register. The AO has disallowed these purchases merely based on the information received from sales tax department that the names are included in the list of suspicious dealers who have not paid back and who have admitted of giving bogus bills. Two questions before sir is that whether merely on the basis of information received from sales tax authorities can the addition be made, and second, whether this can form the basis of information for the purpose of reopening of the assessment.
There are a large number of judges. I am not going into it except to say, if there should only one SSC, Bombay High Court, upheld reopening for assessment year 5-6 in the case of Nippon exit, but in the very SSC for assessment 1-2 on merits it held in favor of SSC by saying that mere information from the sales tax department is not good enough. If SSC can show goods have come, they will be utilized, adequate proof to show that they will actually receive payments are made by account being checked. There is nothing to show that is about that is only paper transaction. Then merely because the vendors are not coming forward, no action can be made. In fact, on this issue, you will find an interesting unreported development of Gujarat High Court, that is of Uttaram Sharma, where the Gujarat High Court has approved the tribunal theory that if there are bogus purchases, unless purchases are found to be at a rate higher than the market rate, or the goods are not reflected either in the sales or in the growth in stock, no addition is required to be made. Otherwise, Gujarat High Court, in Vijay Road, they say 25%, in Gujarat, they say 5%, in Sanjay Valley, 25%, in Civic, 12.5%. There are various percentages. Vijay Protein has now been confirmed by Gujarat High Court at 25%, but Uttaram Sharma is a direct judgment saying 0%. So also this is liquid exit 48%.
Next question.
The issue is about VAT refund issued by industrial building, which is doing ATIB. The department is doing this ATIB version on the ground that the profit is not derived from government. So there is on the resource Supreme Court decision, there is to be working here.
Two questions. In fact, the more fundamental question would be whether this is at all an income. Should we not really raise a contention that this is a capital receipt? There are a series of judgments taking the view that subsidies received in the form of sales tax refunds or non-payment of sales tax would be a capital receipt. If it's a capital receipt, the whole controversy will go away. At least there are two Gujarat High Court judgments, Birla Gates and Punjab. I will be giving them, so I am not getting into it. There is a right, especially in order of reliance. So it will be a capital receipt. Assuming it is not a capital receipt and you take it as a revenue receipt, then we have a direct judgment of the Uttarakhand High Court taking the Meghalaya Steel that such kind of receipts will be eligible for deduction for section 80. But I go a step still forward, assuming ATI is not admissible. Why can I not invoke the principle of netting off? This is the sales tax. So I have claimed expenditure and I have also got received by way of return of that expenditure. I net off the two. Only problem would be if I claim the expenditure in year 1, 2, 3 and if I get subsidy in year 4, netting off will not be possible. But if I am sure I am getting subsidy, then in year 1 I will credit the income, debit the subsidy receivable, I have netting off. Because Gujarat High Court has now taken a view in Nirma 367 ITR 12 that even for the purpose of ATIA, every receipt has to be netted off. Or if you put an ACG capsule for ATHSC, every receipt has to be netted off. So there is a receipt, and against there is an expenditure, only net receipt will be excluded from the purpose of claim of ATIA. There were 3 answers: capital receipt, 2 in any case ATIA, 3 in any case netting.
The next question on reassessment, whether it is mandatory to file the return of income? Because normally in the practice we have that the return filed earlier or on such date may be treated as a return file. This is a standard letter that we have a practice of filing when we have received the notice under section 148. But we have one against decision of G and Mohan Raju of Bangalore Tribunal, which says that the return, if a plain letter saying that the return filed on that particular date would not be treated as a return file under section 148. Whether still the AO can insist that yes, you need to have filed the return of income.
I think Mohan Raju doesn't really exactly say that you cannot file. What it says, you have the right to insist that you file return of income. In that one, suppose I write a letter today saying, sir, please keep my original return under 148. He might tell me, no, you file a return. In which you file the return. He cannot sit back, do nothing on my letter, and then while passing the order, he may say, I am doing the 144 because you have not filed return of income. To recollect old litigation as regards Form 6 for delaying filing return of income. SS used to file Form 6. Department was not responding to it, and then the SS used to argue, courts have accepted that if you do not want to accept the request of the SS, you have to tell the SS. You just cannot say in the body of the assessment order that I would not accept the return. So my view is that Mohan Raju, if you read in proper perspective, what he says, AO would have a right to insist that you file return of income. We do it for the sake of convenience. If we are told you have to file, I don't think anybody has a reason to file it, because it's not as if there is a cost attached to filing return of. It's not like a filing fee of 50,000 rupees or 10,000. It's for the sake of convenience we are doing. So if we are told, we would be in a position to file. I am very clear that AO cannot say that you did not file return of income in spite of my telling you to do that. You wrote a letter to me which I have ignored, and now I go ex parte assessment under 144. That I am clear that you cannot do.
Another one, the capital gain on agricultural land, where the land is situated beyond the municipal limits, and it is shown as agricultural land in the revenue records. However, after the purchase of the land, no agricultural activity was carried out, or agricultural operations were carried out on the land. Whether on the sale of this land, the assessing can contend that the sale of this land is a agricultural land and therefore not liable for capital gains.
In the case of Sharifa Bibi Muhammad Ibrahim, 204 ITR 621, Supreme Court has said whether land is agricultural land or not is a matter of mixed question of law and fact. There are factors in favor of SSC, there will be factors against SSC. Again, in 2 minutes, SSC sold a piece of land in the city of Surat next to the railway station. The factors in favor of SSC were it was for all the earlier years used as agricultural land. Since last 4 years, it was not used for agricultural purposes, but it was not used for any other purpose. Land was in the revenue record treated as agricultural land. Surrounding lands were agricultural land, and SSC had no other activity. The factors against the SSC were it was in the middle of the city. Land was thereupon converted to non-agricultural land. Land was sold to a cooperative society for the construction of residential houses. And for the last 4 years, SSC had done no agricultural activity. After narrating facts in favor and against the SSC, the Supreme Court said that on an overall basis, we take a view it is not an agricultural. The reason why I am discussing the judgment is, therefore, whether the land is agricultural land or not would essentially be a question of fact. The fact that no agricultural operations have been carried out is a strong pointer against you. But if you can go show justifiable reasons that for last 2-3 years, for this reason we have not carried out agricultural operation, but it is essentially an agricultural land and it is otherwise capable of being used as agricultural land, we have done no area, etc. I would take a view to be treated as agricultural land. This is essentially a question of fact and not a question of law.
Said Limited, which is who is into the business of sale and purchase of consumable durables. During assessment year 13-14, they entered into equity derivative transactions on recognized stock exchange and has incurred loss. Now, whether the AO intends to treat such loss as speculative loss. Now, whether if it is treated as speculation and whether it would make any difference if the company was into the business of stockbroking.
I would gentlemen, which is referred to, the delay would refer to the this query against the SSC. Issue is like this. SSC, when it enters into the derivative speculating, the concept of speculating has two different and independent connotations. One for the purpose of section 43 and the other for the purpose of section 73. 43, subsection 5 deals with speculation. But it has, broadly stated, it says dealing in differences. So derivative is always dealing in differences, so it is always speculating. However, certain exceptions are carved out under that definition, and one of the exceptions is eligible transaction in respect of trading of derivative carried out on a recognized stock exchange. So for the purpose of section 43(5), derivative transaction on the floor of stock exchange may not be speculative. However, definition in section 43 is only for the purpose of sections 28 to 41. Section 73 is an independent provision. And expression to section 73 says where a company, barring two exceptions, where a company does the speculative business of purchase and sale of shares. Sorry, a company does the business of purchase and sale of shares, it will deem it to be speculative. To that deeming fiction, there is no exception as is provided in the section 43(5). Therefore, the view taken by Delhi High Court is, though the transaction may not be speculative for the purpose of section 43, by virtue of section 73, it is speculative in nature. And therefore, the loss on derivative transaction cannot be set off against your share broking activity. Answering second question, whether the answer will be different if this is a stock broking activity. Again, answer is negative. Two exceptions to which I made a reference are: one, to put it simply, if income under the rest of the heads is greater than income under the head business. And second, if the principal business of the SSC company is granting of loans and advances. If with the share broking activity, obviously there is land, it should be having larger business income. First exception will not apply. And because it is the share broking, principal business is not giving up loans and advances. There was an exception also not apply. And therefore, in my view, if even if the SSC is the business of share broking, answer will not be different. SSC will not be different. With this, I come to the end. I am sorry I thought to be in a better form. Unfortunately, because of my illness, I could not do as much as I would wish. Thank you very much.
Friends, we received many questions from the members as after making an announcement that we have a great interest session, and after possibly announcing the name of Sopakar sir that he is a great trustee, we had to filter the questions, we had to reject certain questions, maybe because of the repetition, maybe because of the time limit. In the process and in the greed that most of the questions should be covered, we did make certain adjustments and club certain questions like TDS, let us club it all together so that the number of questions are reduced. But well, though the number reads as only 27, the number of questions that Sir has answered are 33. And he himself did not stop there. Certain practical issues which we saw maybe filing the return of income, though the questions were not directly posed before him, he still went ahead and answered, himself created the questions and answered the questions which were very helpful to us and which are going to be very well. Sir, I must thank you very much for spending your valuable time and answering the questions. In spite, again I would say that in spite of his ill health, he still asked me how much time do I have to curtail. It's because of certain free time that we need to give to the members present over here, we had to reduce this time. Otherwise, possibly Sir was prepared from his side that we would have extended for another half an hour or so. With these words, I would request Ketan Bhai to present a very well-deserved vote of thanks to Sopakas.
Good evening, everybody. The RRC of Chamber is now becoming almost a real pilgrimage from many of us. This pilgrimage reaches the biggest peak when we go to the brain trust session. And that is because gurus like Supakar sir joins us in this pilgrimage when we go to the brain trust. Then brain trust is the most looked after event in the entire RRC. The reason is very simple, that the day-to-day questions which we face in our life are being answered by the eminent faculty in this session. And this year also our brain trust has not been an exception. The technical discussions were of course good, but today's brain trust was always icing on the cake. Friends, the RRC started with a technical snake of area 5, which all of us suffered and some of us suffered. I am very happy to note that the technical snake which was there at the beginning has ended with a technical perfection in the form of presentation by Shri Saroj Supakar. The theme of RRC, Swachhatan, Swachhaman, Swachh Bharat, has also been achieved. When we say such Swachhaman, yesterday we had all been to the darshan of Lord Jagannath, and we have got very positive vibes as far as the worldly evils are concerned. We have already been able to reduce some of them. But for a professional, Swachhaman also includes clarity of thoughts. Because unless and until you have clarity of thoughts, you will not be saying that my man is that swatch to service my client. The clarity of thoughts which Shri Supakar sir is possessing is really adorable, and with this he has shared all his experience with all of us in his eminent style as always. Every time we have his benefit, our belief in him strengthens to a greater extent. With these few words, I would request all the participants to propose a very, very